Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoteric Capital Markets. Today's topic is on the oil market. I just want to take an in-depth look at the oil market today. So let's jump right in here. We're going to look at the oil price term structure to start with. All right, so this is, again, the price of West Texas Intermediate Crude, and the green line shows us prices at the start of the year for 1 month deliveries out to 12 months, okay? And then we have the blue line was as of the end of April, and then mid-June here. You can see mid-June is the orange line. So prices haven't moved much since the end of the month, all right? So the brown line here and the blue line are pretty close to one another, right? And also notice that there's a slight upward slope to this curve. What does this tell us? Well, this tells us that the market is willing to pay for storage right now. They're willing to pay for storage. If you hold the oil for 12 months, you get that price differential there between the 38.6 and the 36.3. So we're back to a positive carry scenario, right? A positive storage cost scenario. Notice at the start of the year, right, the near-term price was $61 for a barrel of oil. The 12-month price was $56. So there the market's telling you not to store oil, that all the oil is needed today. It's needed as quickly as possible today. But again, that's not the environment we live in today. All right, let's go to the second start. Let's just look at performance so far this year. Here we have the entire commodity markets here. We have the energy complex, we have metals, and then the ags. All right, so first thing to notice is that almost everything is down on the year, right? That's the demand destruction. We're picking up the demand destruction from the COVID-19 virus, and it's showing up everywhere. But where's it hitting the hardest? Again, in some of the energy areas. You can see global crude here. Brent crude is down 41%, and West Texas crude was down just over 40% for the year. Okay, so a 40% move, right? Why or how did oil prices move so much more than everything else? Well, in addition to the demand destruction that we're seeing everywhere, there's also, of course, been supply disruption. And here, supply disruption means excess supply. We've got a tremendous amount of supply on the market right now. So we had demand falling, supply increase, and that gave rise to the 40% drop in oil. Okay, so that's yesterday. That's what's happened so far. What about going forward? Let's look at the information for that question. Here we have four different charts. We have crude inventory levels. This is high frequency information. It comes out once a week. And these are inventories that do not fall in the Strategic Petroleum Reserve. All right, so inventories, where are we at in inventories? It's a little hard to see, but we're actually at all-time highs right now, right? At levels that we've never seen before. All right, that's not a good sign usually. That's not a good sign when we have this level of inventories. Now, the interesting thing right now is that we have a lot of inventories in a lot of areas, not just oil, because a lot of inventories were built up over tariff concerns. And then, of course, we had the tariff concerns, and they were followed by the coronavirus. And that left us with a tremendous inventory problem. All right. So we have a lot of inventory. We have a lot of inventory in oil right now. Now, in response to that 40% drop in oil, here we have the oil rig count. All right. The number of oil rigs. Again, another weekly observation. You can see that thing has just completely collapsed. The so-called energy renaissance, right? The U.S. being self-sufficient or getting closer to being self-sufficient and so forth. You can see that has completely erased itself. Now, in fact, we have wiped out the entire time period from the Great Recession, right? The 2008 recession. We have wiped that out completely, and you can see where we're at today. It's as if the U.S. doesn't really even show up on the map in terms of the number of oil rigs right now. All right, so we have inventory. We have the rig count, which would tell us something, right? They're trying to take supply out of the market. The U.S. is certainly trying to take supply out. And they're being responsive to the 40% drop in prices. Here's total oil production, right? Not just the U.S. The rig count in the U.S. would tell us something about it, but here we have total U.S. oil production. And it has come down, but it's only come down slightly. Again, the black dotted line tells us where we were at on the most recent weekly observation. So it has come down, but not very much. All right, so this is production. All right, this is supply. Over here we have demand, total oil that is consumed. And again, we've bounced a little bit from the really slow social distancing time. We've bounced a little bit, but take a look at where we are at today. In terms of consumption, we're still at the early 90s. Now, again, this thing's not adjusted for the population. Obviously, the population has changed a lot since the early 90s. So our consumption levels are at the early 90s right now, but our population is not. Right? That's not good. So again, demand is still terrible. Supply is still high. We're trying to bring it down. We're trying to bring it down as quickly as we can. But inventories are full as well. All right, so we put all these things together, right? Oil has fallen 40%. Now, where do you think it goes from here? I got to say, I'm still not liking this scenario. If I look at the supply, demand, and inventory levels, demand would just have to increase just remarkably fast to set off the supply that's in inventory today and the supply that's available worldwide. All right, so it's not a real encouraging move, or it's not a real encouraging picture, near as I can tell, from the global oil markets here. So, from an inflation perspective, again, we've had really, really depressed levels of inflation. And the Fed's likely to tell us it's transitory. They're not going to get too upset, worried about deflation. And one of the reasons for that is, again, prices have rebounded. That's not going to show up in the inflation data for some time, but energy prices and oil prices in particular have rebounded. Again, think of the negative $40 oil versus the $35 to $40 oil we have today. So from negative 40 to plus 40. That's quite a rebound. And eventually that'll show up in the inflation metrics. But again, I think this run up to $40 oil, I believe, I fear that may be transitory as well. We may be going to give some of that run up back because the demand and supply conditions just do not seem to be in line with each other right now. All right, so that's our message for today. I'm Don Rich, and you've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.